If you are anywhere near retirement age, you need to pay very close attention to what I'm about to tell you, because the IRS just released updated numbers for 2026. And these changes could either save you tens of thousands of dollars over your retirement or cost you tens of thousands if you do not plan around them correctly.
The amount of tax you pay next year could be changing.
Property investors are bracing for a shake-up in tax rules as part of next month's federal budget.
Today, the opening of the tax filing season.
Most people have no idea these changes even happened, and by the time they find out, it's already too late. They have already made decisions that locked them into paying way more taxes than they needed to. So today, I'm gonna walk you through exactly what changed, how it affects your retirement income, your Social Security benefits, your Roth conversions, your capital gains, and more. And I'm gonna show you the specific traps you need to avoid so you do not pay tens, if not hundreds of thousands of dollars. My name is John Mall. I'm a financial strategist and retirement planning specialist that optimizes assets, minimizes taxes, and helps you empower your true wealth. Over the past 7 years, I've helped clients save hundreds of thousands of dollars in taxes they did not even know they were going to owe. Here's the first thing you need to understand about 2026. The standard deduction went up to $16,100 for single filers and $32,200 for married couples filing jointly. It's about a 2.2% increase. That might not seem like a big deal, but that is exactly how most people think about it. Here's where it gets tricky for retirees. If you are age 65 or older, you get an additional deduction on top of that, $2,050 for single filers and $1,650 per spouse for married couples. That means the same couple could add another $12,000, bringing total deductions to $47,500 and potentially allowing that much income to be completely tax-free. However, this deduction phases out based on income starting at $150K and disappearing entirely at $250K for married couples. This is where planning becomes critical, because if a Roth conversion or another income decision pushes you over those thresholds, you're not just paying taxes on that income, you could also lose thousands in deductions. That's a double hit most people never see coming. Now let me talk about tax brackets, because this is where opportunity really opens up. Many people think all their income is taxed at one rate, but that's not how it works. Tax brackets function like buckets. Your income is taxed in layers, starting at 10%, then 12%, then 22, then 24, and so on. You have your marginal rate, which is what your next dollar is taxed at, and your effective rate, which is your average rate. In 2026, those lower brackets expanded, meaning you now have more room to recognize income at lower rates. If you plan properly, you can intentionally fill those lower brackets instead of accidentally spilling into higher ones. Most people just take distributions when they need money without thinking about where it lands, and they end up paying thousands more in taxes because of it. Now, let me talk about something that catches a lot of retirees off guard, which is how capital gains interact with your other income. Capital gain is the profit when you sell something for more than you paid. And if you held it for more than a year, it's taxed at 0%, 15 or 20%. For 2026, the 0% bracket goes up to $98,900 for married couples. But here's where most people miss. These brackets are based on total taxable income, not just your gains. Your IRA distributions, pension income, Social Security, and other income all count first, and then your capital gains stack on top. So you might think your gains are tax-free, but in reality, they can get pushed into higher brackets. For example, if you take $80,000 from an IRA, then realize $50,000 in gains, a large portion of those gains may be taxed at 15% instead of 0. This is why income planning matters so much in retirement, because where and when you pull money completely changes your tax outcome. Now, here's another surprise for many retirees: IRMAA, which stands for Income-Related Monthly Adjustment Amount. This determines how much you pay for Medicare. If your income is too high, your premiums increase. Unlike tax brackets, this works like a cliff. Go over the threshold by just $1 and you pay higher premiums for the entire year. These increases can cost hundreds or even thousands of dollars annually. And to make it more complicated, Medicare looks at your income from 2 years ago, so decisions you make today can impact your costs later. There are also parts of the tax code that have not changed in decades. For example, the net investment income tax applies once income exceeds certain thresholds that have not changed since 2013. And Social Security taxation thresholds have not changed since 1994. That means more and more retirees are paying taxes on their benefits, not because they're earning more in real terms, but because the thresholds never adjusted. The bottom line is this: you cannot just wing this. Your deductions, your tax brackets, capital gains, Medicare premiums, Social Security, they all interact with each other, and one decision you make today can cost you thousands down the road if you're not paying attention. If you're wondering how to apply this to your situation, that is exactly what we help people do. We sit down and map everything out, just so you know exactly where you stand instead of guessing. If you're between 55 and 70 and sitting on a large IRA or 401k, and you want to see if there's a smarter way to structure your retirement income, there's a link below to apply for a free strategy session. We will show you what options you may qualify for and what kind of tax savings could be available so you can move into retirement knowing you're not leaving money behind. If you found this valuable, make sure to like the video and subscribe, and I will see you in the next one.